Hi, today I'm going to talk to you about the eighth wonder of the world. In other words, compounding, or compounding interest, better known by. Now, the reason I call it the eighth wonder of the world is that it's reputed that Einstein once commented that compounding was the eighth wonder of the world. As it turns out, on further research, he probably didn't actually say that. Nonetheless, it's perfectly a plausible thing he may have said when you look at the magic of compounding. Now, what do we mean by compounding? Well, some people describe it as earning interest on your interest. So let me give you an example. Let's say you start off with, say, £100, then you earn, let's say 5%. I know it's unrealistic today, but in the past it hasn't been. So you got to £105, and then you earn another 10%, but this time it's not, sorry, not 10%, 5%, but this time instead of earning £5, you will earn 5% of £105. So the amount you receive will be proportionately higher, slightly more than 105, slightly more than £5, because you're earning 5% on £105 and so on. Let's say it goes to £111, and then next year you get another 5%, and instead of earning £5, you're getting 5% on 111. So let's say it goes up to 117. So 111, then 117. So you get the picture. It just keeps rising at a higher rate, because you're earning interest on your interest. You're not earning it on the original £100 at £5 a year. Now, there's a formula known as the rule of 72, which is a rule of thumb method of calculating two things. One, how long it takes to double your money if you're looking at growing an investment in size, and two, how long it takes to halve your money if you're using the percentage figure as an inflation measure. So let me give you a very simple example. Let's think of a return of, say, 7.2%. So what you do, you take the number 72, divide it by the interest rate you're earning, or your return, your investment return, 7.2. 72 divided by 7.2 equals 10. What that means, it's a rate of return of 7.2% a year. It takes you 10 years to double your money. Why is that important? Well, I think it's just a very useful rule of thumb, isn't it? It stands to reason if the return is 3.6%, and it will take you 20 years. The sobering thought is that a lot of people got money in the bank earning them a tiny amount of interest. So if you're lucky enough to get even, what should we say, 0.36% interest, I think the figure comes out at 200 years. The point being is that leaving your money in the bank is just going to earn you virtually nothing. It's going to take a long, long time to make your money grow. So you need to be investing in assets that have got far greater growth potential, that will help make your money grow. And if you're looking at shares, I think a long-term record of share returns of around about 7% a year, which is about the long-term average in the US stock market, for example, over the last 200 years, 100 years, 50 years, 20 years, you name it. It's a fairly good approximation of what you would make if you're prepared to invest longer term, in other words, 10 years or more, in an asset class called shares that will fluctuate more in value than bank deposits, clearly, and they are higher risk, but nonetheless, that's where most pension schemes invest their money, and people don't consider their pension schemes high risk, do they? So it does make sense to put your money in what we call real assets. Property and shares are two of the main assets you can invest in, and a real asset being an asset that's got the ability to grow, keep pace with, and even beat inflation. And if you invest in those kind of assets, you can use this rule of thumb method to work out how long it would take to double your money. Quite interesting, I feel. Now, the reverse of that is to use this rule of 72 to work out how long it takes for your money to depreciate. In other words, if you have high inflation, what toll does that make on the real value of your money? And I think the best example of this is a bank deposit, because most people in the UK are currently earning tiny amounts of interest, often 0 or 0.2, 0.3%. If you're lucky, you might get maybe 1% if you're very, very lucky. So if you're making those kind of minimal returns, and inflation returns with a vengeance, and I think it will, because it's inevitable at this stage of the long-term economic cycle, you start getting inflation at high rates. Remember in the 1970s, the average was in the teens for a whole decade, which is pretty high, isn't it? Teens being 13 to 19% for a whole decade. I mean, it's unbelievable, really. I'm not saying it could return to that level, but inflation certainly will return. Well, if inflation were to be 7.2% a year, then your money would halve over 10 years. That's what it means. In real terms, inflation-adjusted terms, the value of your money in that bank account could fall to half. Now, the capital sum will stay the same or go up a little bit when you add the interest, but because prices have risen, the cost of living's gone up, then the true value of it in terms of purchasing power has halved if inflation is 7.2% in 10 years. Now, if inflation was even 3.6%, even that would take its toll, would halve your money after 20 years. You think inflation couldn't return? Think again. Just look back in history, search it on Google if you don't believe me, and you'll find the great destroyer of wealth is inflation. So do remember, it may not officially have been announced by Einstein that compounding is the eighth wonder of the world, but it truly is a magnificent way to make your money grow and protect against inflation.